We continue to see strong macroeconomic conditions, at least at the macro level, as evidenced by healthy employment growth. We saw a bit of a surprise upside in May, though at the same time, this belies softness below the headlines. Unemployment rate has ticked up. We saw it today actually tick up to 4%. Still low, but it's moving up. Consumer sentiment is I'd say low or depressed at this point, and so on. And then there's, of course, inflation, steadily declining, but it's choppy. And I don't think anybody is satisfied with the pace of the decline in inflation. It's really not going down as quickly as anybody would like to see. This, of course, is leading to higher interest rates and discount rates for all asset types, lowering asset values, leading everyone in real estate to ask when we might get some relief. I think there was some optimism earlier this year that we might see more rate cuts. That optimism has left the building. We're unlikely to get, at least the consensus says we're unlikely to get much relief on the rate side this year, as long as inflation continues its slow but steady decline and the economy stays healthy, which has, is really an important part, I think, of the primary topic of today's webinar, which is build to rent single family. High interest rates are, of course, meaningfully impacting all real estate property types. But for income producing real estate, industrial, multifamily, and so on, the impact so far, at least, has primarily or even solely been related to the capital market side of the equation. So financing and the value of the real estate itself. In build to rent single family, on the other hand, and I'd say this is the case in other forms of residential as well, the increase in interest rates is having impacts on both capital markets, so values are down and so on, and also property markets, which is really the demand side of the equation. So first, in capital markets, of course, high interest rates and discount rates have absolutely lowered asset values and made it harder to finance investments, which has made it much more difficult to develop at this point in time, which has kept a lid on the supply of build to rent, I think, to a much greater degree than we would have anticipated a couple of years ago. But second, these higher interest rates, which you can see here, ticked below 7% for a moment, but are still high at 6.99% on average, combined with still sky-high home prices, have made it much more difficult for would-be homeowners to purchase homes, leaving them as renters for longer and thereby increasing demand for rental housing, which we think is especially the case for single-family rental homes, especially since many of these housing consumers are at the life stage where apartment living is just becoming more and more inadequate. So challenges and opportunities, which I think is a good theme for the conversation today. With that, on the macro side, I'll turn this back over to you, Josh.